Hey guys, what's going on? So this is going to be another video in the strategy section, and it's going to kind of be a rehash of my evening analysis that I just did. It's going to be on standard deviations. So if you don't know what a standard deviation is, you should maybe look into it as far as statistics. It's just basic statistics. So like, what is a standard deviation? So you have a mean, right, and then you have standard deviations outside of the mean. Right, and oftentimes when we're referring to markets, the mean can often be the midnight opening price, right? So this is our consolidation area, and when we think about the standard deviation, when it comes to the average daily range, right? Let's say if euro has 100 pips average daily range, well, if it's going one direction, right? Let's say if it's going to one, two, or three standard deviations outside of that, oftentimes it's already reaching the outer boundary of the daily range. And most likely it's going to snap back to the open or below, right? So a lot of this information can be found in month 8 of core content for 2017 mentorship by ICT. And that's essentially the only model I use. Like, I don't look at any of these new models and methods that he's producing, because I found what works for me, and that's all I really need. I don't need to go outside of that. All right, so let's kind of dive into standard deviations. Let me see if I can pull up some of my notes, because there are certain standard deviations that you have to measure, but this one indicator does it all for you. So let's see if I can find. Sorry, I'm just gonna pull up my Notion real quick. um, So I believe, right, the Asian range has to be between 20 and 40 pips for you to be able to use it. Right now, you can see that this is in red, right? So if the Asian range is between 20 to 30 pips, I believe. I'm not sure if I'm going to have my notes for this, but let's see. I have the actual pips on what the ideal number of pips is for each one of these ranges. I think the Asian range has to be between 20 and 30. If it's outside of that, let's say if it's 19 or 40, you use the central bank dealers range. And then if the central bank dealers range is not a certain amount, then you have to combine it and use the flout. Again, you can go into ICT's day trading essentials and figure out what those pip counts are. I haven't looked at them in a while because I've just been using this indicator, which will automatically choose if it's flout. So if it's the flout, right, the flout, they'll take 50% of the range, right? So this is the flout. It'll take 50% of the range and then calculate the standard deviations based on that. So you can see 50% of that flout range is essentially a standard deviation. Right? If it chooses the Asian range, let me see if I can find one here. Right, if it chooses the Asian range, well, it's going to use the Asian range, the full Asian range, to determine what that standard deviation is going to be. If I can just click and drag this up, right? So that's one standard deviation up, two standard deviations up. So when we think about how we position ourselves inside of the market, it really comes down to your time of day and where the market's trading. So if I am expecting bullishness or bearishness, when I come to the market, I want to see the price. Let's say if I'm bullish, right? I really want to see price trading below the midnight open when it comes to my kill zone. If it's not trading below the midnight open, and let's say it's trading up here during my kill zone, and I'm bullish, then I most likely do not have a trade, right? Because if I enter a trade up here, there's a risk of it coming back to the midnight open. All right. So use these standard deviation levels as your premium and discount levels. All right. So when you're trying to go long, yes, you want to go long at a discount level, right? And oftentimes these standard deviations will line up with various it's buy side and sell side imbalances, right? So we have this BISI that we were looking at, right? And if this is trading at this point at a kill zone, we've already taken out London low. Well, it's probably not going to come any lower, right? We've already kind of tapped liquidity in here. We've already hit one standard deviation. So you could essentially go long in here, right? Put your stop at one standard deviation, maybe even, sorry, two standard deviations, or even three standard deviations, right? You have a 15 or, sorry, 14 plus, I would add the spread. So maybe 15 pips or 23 pips as a stop loss. And you would possibly target somewhere one of these upper standard deviations, right? Maybe it's 50, maybe it's 57. Um, and that's just essentially how you're doing a one shot, one kill, right? And then same thing here, right? We have our midnight open trading down into a standard deviation. And what's lying below that standard deviation, right? We have this fair value gap lying below the one standard deviation. So when it comes to the kill zone, look at the time, right? This is 8 a.m., 9 a.m., 10 a.m., 11 a.m. So essentially, you have 4 hours to position yourself long below the open, right? On each one of these daily candles. And if I go over to the daily chart, right, the most money that you're going to make is inside of the wick. So on all these bullish days, right, if on all these bullish days, the best price that you can enter is inside of the wick. Right? Let's say if I'm trading inside the wick, I'm going long inside the wick, and you're trading and you're getting in long above here. Who's going to make more money? The person inside the wick, me, or you trading up here after the market's already moved? All right. So you have to understand that when the market's trading lower and the market looks really bad, is the best time to go trade in the opposite direction. Right? If you're bearish, you want to see price trade against order flow, right? If I was bearish inside here, I really want to see it trade up into one or two standard deviations, right? And use your previous day's highs and lows, right? Or some type of other PD array from the previous day. Like you can use this order block, right? And this is a really extreme move. Like this is moved way outside of four standard deviations. So let's say if you went short in here and place your stop above this high maybe from the previous day, because we're way past the standard deviations, and this is probably the effect of news, right? Because oftentimes in the news it can have pronounced moves past standard deviation levels, right? Let's say if you risk 20 pips and you held this for a couple days, right, as a one shot, one kill, right? Where could we possibly target? We possibly target down in here. This is inefficiency, which is 60 pips, right? That's a 1 to 3 risk reward, right? You just have to have some patience because many times it's just going to keep chopping around, and uh, you don't want to move your stop too soon. I mean, even here, right, when it pushes down into three standard deviations during London, right, if you're up during London, this is a great place to take partials and move your stops to break even, right? Otherwise, this market's going to come all the way back on you, possibly take you out, and then it's going to go down again. Same idea here, right? If I'm bearish from the previous day, it's trading up to 1 to 2 standard deviations, right? And it's like that rubber band effect. When it gets too far outside of the mean, when it comes to this standard deviation, right, versus variance, you have to understand once it gets too far past the average daily range or, the outer boundaries of these standard deviations, that is most likely going to trade in the other direction. So if I am going along, again, I'm using these standard deviations as my discount levels, right? Coupled with time of day and the kill zone. And maybe you pair this with an OTE, right? So now I have three confluences, right? My Judas swing, a fair value gap, and an OTE level. So those are three confluences that you can use to position yourself inside of a swing. All right. And there's multiple confluences that you use. You use a breaker, you use an order block, you use a turtle soup. I mean, that's essentially what I'm doing. I am just using all these PD arrays coupled with the standard deviations to position myself intraday. And that's really all you have to do is you don't have to overcomplicate it. Just understand where you are on any given day, right? If I'm bearish, if I hold a bearish bias, any short above the open is better than me shorting it down here, right? If I short it down here, right, this thing's running back up on me. So if I short it here, right, let's just say for example, this is how you want to be efficient with your entries and how you get really precise. If I shorted it right there, right, I'm only getting like a 1-to-1. But if I short it above the open, let's say if I short it above the open, right? If I short it up here and I use the same stop loss, now all of a sudden I'm getting a 2.4-to-1. Do you see the difference? It's just having that patience to wait and position yourself on a sniper entry to get short above the open. And that's kind of how you want to trade inside of the wicks. All right. You don't want to be in the body of the candle, right? Like let's say if I go short in here below the open, same idea. Like let's say I go short somewhere in here below the open. So that's the weekly open. It'd be really hard to get short in here unless you're trading the turtle soup setup, right? But let's just say I'm using one of these standard deviations and I'm shorting it, or sorry, I'm going long below or at the midnight open, right? So 2.6, 2.5, maybe three, versus if you go long above the open. Let's say if you go long above the open. Well, where are you going to put your stop loss? Now your stop loss has to be at a really steep level. Maybe it's got to be below this fair value gap, right? Again, you're only getting like a 1-to-1 efficiently. So if you miss the move on a day, you're better off just waiting for the next move, right? Instead of me entering it here, I'm not going to chase the market, right? Because the following day provides another opportunity to go long, right? Inside one standard deviation of this flout range, right? If I'm still bullish, I actually want to see this trade lower during New York session. And many times this will line up with a medium or high impact news event, right? So these intraday highs and lows, you need to go back and study them because they happen at the same time almost every single day. And the weekly profiles form almost the same way every single week, right? So if we keep pressing higher from here, right, Wednesday or Thursday, we might see the top of the market and we might get a TGIF setup trading back towards the weekly open. And that's how essentially how I trade week to week. Every single week, I'm looking for standard deviations, or every single day, I'm looking for standard deviations if I'm bullish to go long. And same thing if I'm bearish, right? So if we go over to the CAD, let's just study a couple of these. I'm not a huge fan of the CAD, but there's still opportunities in here, right? So even if it's not reaching into that high standard deviation level, well, the market is extremely bearish, right? And so we're contesting with this order block in here, right? So oftentimes it doesn't have to hit that standard deviation level. Many times, just running out the Asian highs can be enough, right? So you have those Asian highs, we have an OTE level, right? And all you have to do is use those two levels, right? This order block, OTE, right? It's hard to see right now, but it's pretty much right on the 70% OTE. All right, and you're targeting maybe just this low, right, as your first target, and then this extension as your second target. All right, let's go into the high on this week, which was Friday, TGIF setup. This was NFP. This was an amazing setup. Look how almost perfect this is on a standard deviation. So if it's trading up here, right, London, we've already seen the high almost put in, and you're expecting the weekly range to be tapped, right? And this is your TGIF setup. So if you have Monday, right, this is our weekly open. Look how far away it's traded from the weekly open by Friday. So when you're coming to the market on Thursday, this is your standard deviation. If you get so far away from the mean, right? From that weekly opening price, we are at a major premium. So many times I've seen this happen where we've gotten so far away from the weekly open and then we just collapse back towards the weekly open, right? And this happens every single week. You're going to expect one range to be capped by Wednesday, Thursday, or Friday and trade back towards that weekly open, right? So when we come to the market during New York session, right? Typically, I won't position myself on NFP prior because the spreads, right? So even if this wicked up here, the spread could have been 20 pips at the time and taking you out, even if your stop is above here. Let's measure this. Even if your stop is 16 pips, right? If they open up the spreads to 20 pips, you're going to get taken out, but the market's not going to print like that. So a lot of times you just want to avoid those extremely high impact news events, right? So on this candle close, 9 a.m., right, you still have an opportunity. It's retracing back up to go short, right? And there might be some more information on that candle that you could have used to get short, right? So we actually do have this fair value gap that you could have used to go short. And it provided plenty of time to go short, right? You had 5, 10, 15, 20, 25, 30 minutes while it's trading inside of that fair value gap to go short. And then you can actually have a decent stop right after the news is settled, maybe 17 pips to go short, closing around London close. Again, here, right? If you're going short above the market, you want to use these standard deviation levels as areas to put your stop loss. So maybe I'm going to go short in here. Even if I go short in here, right? And then I don't know if I want to put my stop here, right? Like maybe I want to put my stop all the way at the first standard deviation, right? They're giving me 22 pips of breathing room. That still allows me to take advantage of possibly a 2-to-1 or 3-to-1 move. All right. So you don't want to choke your trade out by saying the London high is going to be the high of the day because on CAD, typically the high of the day, high or low of the day is going to be made during New York, not during London. All right, so New York is often providing the high or the low of the day, right? Same thing here. We've just taken out Asian range highs. We really don't need to see it trade up to these standard deviation levels, but when they do, oftentimes it can provide a great opportunity to go short or long. But again, it's not required. It's more about time. What is the market doing during that kill zone? And my operating hours is usually like 8 a.m. to 11 a.m. If I don't get the move that I'm looking for within that time frame, then I'm typically not doing anything. So I already talked about this on my weekly review, but a lot of people are asking me, what is my confirmation? And oftentimes my confirmation is just that it's trading lower, right? I'm not waiting for confirmation. Usually by the time I wait for confirmation, the move is already done. Like if you're waiting for this old high to be broken, the move's already gone. You want to position yourself, and you can check the Discord when I said, watch out for this fair value gap, right? And that's literally all you need. This is the information that you should be looking for is what is it trading into? Even though this 4-hour candle closed extremely bearish, I don't care about that. I'm going to go long, right? And allowing that next candle to close is giving me confirmation to hold the trade. But oftentimes when I'm positioning myself, the market is going against me, right? And all I need to see, right, if we hop into the standard deviations, that 4-hour fair value gap, we have two standard deviations that are sitting within it. So when I come to the market at 8, 9, 10, 11 a.m., is giving me so much time to position myself inside of this market. Like I don't have to be perfect, right? And I don't have to wait for confirmation to tell me that this market's going to turn around because I have a higher time frame narrative in mind that I'm trading. So all I need to see is trading inside of a 4-hour fair value gap, trading at one of these standard deviations, trading at an OTE level, right? I don't even have to draw this. I can visually see that it's trading at an OTE level and it's trading below the midnight open, right? So I have like four confluences in mind that's allowing me to position myself without confirmation, right? Anywhere in here is a good price to enter long, regardless of what the candlestick is saying. I don't need to wait for the candlestick to tell me to go long. Like, I'm trading the price, all right? And I'm trading inefficiencies. So um that's my strategy using these standard deviations. I'll try and add more into the strategy section, but I think this is going to be uh, a pretty good one you guys can refer back to time and time again. So with that, hope you guys have a great evening and good luck, good trading.